What the hell is going on with the stock market right now? Interest rates continue to rise, job cuts have gone from the tech sector all the way to the industrial sector, and house prices are still ridiculously high.
A third of the global economy is going to be experiencing a contraction, 2 consecutive quarters of negative growth. And so what we're seeing is, this battle to bring down inflation is underway. It's going to slow down growth. Inflation is gradually going to come down, but next year is going to feel painful.
That is Pierre-Olivier Gourinchas, murdered that name. He's the chief economist of the International Monetary Fund, explaining there in 2022 that 2023 is going to be painful. But recently the IMF have changed their stance slightly, painting a more optimistic future of 2023, particularly in emerging markets like South America. That'll be important later. But it's not just the IMF who are positive, and it's led to a little recovery in the stock market. This could simply be a bear market rally, but it also could be a sign that the market is less pessimistic about 2023 and that we might not have one of those massive recessions that we've been waiting for the past 10 years. Either way, I don't care.
So I've always said if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
I care about how well my businesses are performing and how well they're going to perform over the next 10 years. I try to look at the global economic outlook as little as possible. If you're watching this channel, you know that my name's Paul and I'm brand new to investing. Yes, I am still brand new to investing. Thank you everybody in the comments. 4 years in the market is basically an investing fetus. But a few years ago I started a dividend reinvestment portfolio on Trading 212 and I've been tracking my progress from 0 right up to where I am right now. By the way, don't forget to get your free share worth up to £100 from Trading 212 by signing up through the link in the description below. YouTube is full of investors who have either already made it, and trust me, I think their advice is going to be incredible, or they're just investors that are leading you down some pretty shitty avenues just to get paid. My channel is designed to show from start to finish my investment journey and see if this actually works. I want to see if someone with a normal UK job can build up a pot of wealth and eventually escape the whole 9-to-5 system. And I'm using one of the most simple strategies known as dividend growth investing. There's more simple ways to do this, like index funds, but I find that this keeps me entertained, this keeps me in the market, and just generally keeps me motivated to continue investing into the market, even through the bad times. And after a few wobbly months, I can now safely tell you that I'm back beating the market. Outperforming the market is notoriously hard. Famously, 90% of money managers fail to beat this market, usually being the S&P 500.
How can that be? Why are they so bad at this?
And over the past 10 years, the average investor has also fallen behind. I did some research quite a while back now to find out why the average investor performed so poorly. And in the end, after all the studies, it boiled down to 2 simple things: poor discipline and investing too much in speculative assets. The poor discipline bit is easy. Too many investors take money out when the market bottoms and put too much money in right at the top. 2021 and 2022 were perfect examples of this. Investors, including the professional money managers, get scared when the outlook looks bad, and they usually sell these assets right before the market recovers. Contrary to popular belief, history does not repeat, but it does rhyme. And that should tell us something important about the current market decline. It will probably recover. And I was so surprised that it doesn't only apply to index funds. It applies to any robust part of the stock market. On that note, the only part of the stock market that this doesn't apply to is speculation. That's both speculation on the value side and the growth side. You can do really well with speculation. You can be betting on that one stock that doesn't make any revenue right now but magically becomes this amazing thing. Tesla, Amazon, Google, all of those ring a bell at this point. And you can also make a lot of money on a turnaround value play. You know, that company that isn't doing very well at the moment, looks like it's in a lot of trouble, but one day could potentially come back. But in this case, you have to almost certainly spread your risk, and that's not always a good thing here. One of your choices could do exceptionally well, but the other 30 bags of shit that you put the same amount of money into might not do as well at all. In fact, most of them are going to go to zero. That's just how it works. Over 50% of all stocks ever have failed. That's basically it. And on the other hand, only 4% of the 29,000 stocks that you could have possibly picked between now and 1929, only 4% of those stocks will have outperformed the market. It's an extremely comprehensive study that shows that most stocks will underperform or even fail. Think ARK Invest.
AI is going to enable the most massive productivity increase in our history. And we think that the productivity gains are going to be astounding and shocking.
AI is about to become the hardest piece of ass going into 2023. Just be careful. One proven sector that has outperformed the market for a very long time is dividend growth investing. You can do particularly well also if you buy into companies that initiate their dividend or have not been paying dividends very long. I think personally it's a bit of a myth getting into the companies that are like dividend aristocrats and all that crap. I want to be getting into the companies that are at the beginning of their mature growth cycle. Very niche part of investing that I'm into. But these stocks, in the majority at least, are all very high cash flow, stable businesses that are giving back to their shareholders. And so far, this strategy has done me pretty well. In fact, the only time over the past couple of years that I've actually underperformed the market is the time when I took my money out. I've now got my money back in and I'm back performing again. Thank you. I'm fully aware though that this is all luck or even bad calculations on my part. In fact, I'm almost sure of it, and you should be very wary of people on the internet who tell you that their success is all down to their stock picks and how well they were able to judge the economic market, because they simply can't. And if we can go back to my previous point, the way to beat the average investor is by simply staying in the market and not dicking about with buying and selling.
Only invest in good companies. Try not to overpay, then do nothing, then do nothing, then do nothing, 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 do nothing.
Which brings me to my January 2023 portfolio update. Woo! Current value of my portfolio on Trading 212 is 59,377. I have handpicked a number of stocks here in this portfolio that at the time of buying I believed were very good value purchases. I'm currently 1.61% up in unrealized gains, and as of January 31st, so yesterday, I was 14.49% up in total return. That's the important one because that includes the dividends. It also matters when compared with my benchmark, which is the FTSE All World Index, VWRL from Vanguard. I'm currently 12.45% up on the VWRL, and that leaves me 2% ahead of my benchmark. A whole 2%, man. I'm impressed. My actual income growth from dividends though has taken a bit of beating, only £45.95 received in January 2023. That's not that low comparatively over the past few years. January is generally a low point, but this should be growing a lot faster, and because I've had 1/5 of my money out for the past 3 months, it makes a lot of sense that I haven't hit any of the ex-dividend dates right now, and this is going to take quite a while to recover, unfortunately. Yeah, a bit of a mistake on my part. In January, I earned £8.17 from Realty Income, the monthly dividend payer, £21.28 from Data Center REIT's Digital Realty Trust, and another REIT there giving me £16.50. But it has meant that my dividends for the year in 2022 has come up to £994, which is just touching that 1,000 a year, and I'm making an hourly wage of 51 pence. I'll take it. In January, I made quite a few purchases that I went into a lot of detail on in a previous video where I dumped £10,000 in one day into the market. It was a good feeling. My new buys included Blackstone, which was an incredible buy on my part. Excellent timing. I knew exactly when to buy this stock, no problem. Of course, all planned and not an ounce of luck involved. Brookfield Renewable Partners as well, doing very nicely. Another stock that I bought on a bit of bad news, and the news has kind of turned around on them, which has been very nice for my portfolio. I made quite a big investment as well into Brookfield Renewable Partners, £3,305 in Brookfield there. Another stock that I brought on kind of bad news. Today I've slapped in my regular monthly deposit, and from what it looks like, £15 from JP Morgan dividend that's come on the 1st of February. I've made a £500 deposit today, so what I do first is I always put 5% of that into the FTSE All World Index. That is because I'm using it as a benchmark tracker, and this is how I keep myself together. 5% goes into the All World Index, and that shows me how I'm competing well against it. It's also not a bad idea to buy into broad-based indexes, and this is probably what I'd do if I wasn't investing into individual stocks. I'd just buy the All World Index. So £25 goes in there, and that's been added. So now I've got £490 to play with, and I think I'll do it again through the pie feature on Trading 212. We'll click invest, just find out how much I've got. £490.27, and it gives me a list of targets. This is what I've targeted at, but I do know that there are some companies here that I want to invest more in and some that I want to invest in less today. I don't have too many new investment ideas for this month. I kind of want to add to my current positions, and what I'm going to do is I'm going to look down the list and invest in companies that are below the price that I've paid for them. So Microsoft, for example, is in the red there. Digital Realty is in the red there, but I'm also going to be investing in Digital Realty because it's below the weighting of my pie. Segro and Tritax Big Bucks will get a bit as well, and I'd be looking to add a little bit more into agronomics to keep exposed to that cultured meat space. The main one here though that stands out for me is VFEM, the Vanguard Emerging Markets ETF. With China reopening, and remember earlier we talked about South America doing quite well this year according to the IMF, VFEM has Brazil down in 4th place. And at the moment, while it's underweighted in my portfolio and over the price that I actually paid for it, I think I'm more than willing to put money into the Vanguard FTSE Emerging Markets ETF today. I'm going to set it to custom, and I'm going to add 10% into agronomics. I'm going to add quite a bit more into Vanguard, almost 50% of it there. Digital Realty Trust is going to get about 25% of this here. Segro gets 4% and Tritax gets 9%. And I'm going to put a very small amount, almost a pointless amount, into Microsoft. And one of the most satisfying times of my month, to be honest with you, is when this investing bar goes from 0% all the way to 100%. Although this isn't likely to go to 100% right now because Segro and the Agronomics Investment Fund are both on the AIM stocks, and that's going to take a while to get those stocks ordered. So we end up with a total value of 59,931. So close to the 60,000 milestone. We're really, really close. Okay, Futureport here doing the editing. This was shot on the 1st of February, and I think we all know what happened after the FOMC meeting. The interest rate rose, and oh my god, we had a pretty good day. It proves how much you need to be in the market. If you miss those top 10 days in the market, you're likely to underperform on your portfolio by about 80%. So by the end of that day, I definitely hit 60,000, so I'm taking that. It went up by a lot more over the next couple of days. But right now that's a bit of a maintenance dump just to keep investing into the market, keeping disciplined, keeping going, and hopefully one day this whole thing pays off.